I'm Andy Panko, owner of Tenon Financial. Welcome to Retirement Planning Demystified. This video will walk through the basic structure of federal income taxation. You can consider it a primer on how personal income tax is calculated. I'll be discussing what income is taxable and what's not, what kind of income adjustments or deductions you're allowed to make, how the tax rates are actually applied, and what kind of reductions or credits you may make to your final tax amount. But before we start, remember this video is only general explanations and education. It's not specific tax, legal, or investment advice. Before considering acting on anything you see in this video, first consult with your tax, legal, or investment advisor. The U.S. federal income tax system is complicated and convoluted. For example, not all forms of income are taxable in the first place. And even for those that are, there are lots of adjustments you make before arriving at your final amount of taxable income. And even then, once you know your taxable income and compute your tax thereon, you still may be eligible for credits that reduce that tax bill dollar for dollar. Here's the basic structure of how income is taxed at the federal level. In reality, there's more detail to it than this, but this overview summarizes the majority of things for most taxpayers. And keep in mind, this is only for federal income tax. This is not how state taxes are computed. Each state has its own slightly different income tax structure. Furthermore, all the information in this video is for the 2020 tax year. Let's walk through this. First, start with every dollar of income you receive during the year. But thankfully, the IRS lets you completely exclude certain items of income right off the top. These exclusions are not subject to federal income tax, and in most cases don't even show up anywhere in your tax return. Exclusions from income include things like tax-exempt interest, such as interest payments received from municipal bonds. Also, some of your Social Security benefits are not federally taxable. Specifically, no more than 85% of Social Security is taxable, which means at least 15% of your benefits are excluded from income. Most forms of gift and inheritance are excluded. The person giving the gift or inheritance may have to pay tax, but the recipient does not. Note there are some exceptions to this though, such as in the case of inheriting a tax-deferred retirement savings account like an IRA. All money withdrawn from an inherited IRA is fully taxable to the beneficiary recipient. Death benefit proceeds from life insurance are not taxable. Contributions to tax-deferred retirement savings plans like 401ks, 403bs, and 457 plans are excluded, as are workers' compensation benefits. Also, certain employee benefits, like the value of employee discounts or some types and amounts of life insurance, are not included in income. And finally, you can generally exclude from income the gain on the sale of your primary residence if that gain is no more than $250,000 if you're single, or $500,000 if you're married. After backing out all the exclusions from your total income, you arrive at your gross income. But wait, that's not it. There's a second layer of adjustments you're allowed to strip out from your gross income. These adjustments to income include expenses associated with running a business. You can also reduce from gross income a certain amount of losses you realize upon selling certain property, such as stocks or bonds. Also, educators or teachers are able to reduce their gross income by the amount of unreimbursed work-related supplies they had to buy, up to $250 per taxpayer per year. You can also adjust out eligible contributions you make to a health savings account or HSA. And if you're self-employed, half of your Social Security and Medicare self-employment taxes can be taken out of your gross income. Also for self-employed persons, certain contributions made to retirement plans can be adjusted out. Similarly, even if you're not self-employed, you may be able to reduce your income by the amount of your individual retirement account or IRA contributions. And finally, certain amounts of interest paid on student loans can reduce your gross income. After making all these various adjustments to your gross income, you arrive at your adjusted gross income, which is known as your AGI. AGI is not all taxable. The IRS lets you deduct from your AGI the greater of a standard deduction or the sum of all your eligible itemized deductions. You can't deduct both the standard deduction and itemized deductions, only the larger of the two. Let's start with the standard deduction. If you're single, your standard deduction for 2020 is $12,400. If you're married filing jointly, it's $24,800. And if you're filing as head of household, it's $18,650. Furthermore, if you're 65 or older by the end of 2020, there is an additional $1,300 deduction if you're married filing jointly. That additional amount is $1,650 if you're filing single or head of household. So those are the standard deductions. You can also separately calculate what your deduction would be if you summed up all your eligible itemized deductions. Let's take a look at what can be itemized. To the extent you have unreimbursed medical or dental expenses in excess of 7.5% of your AGI, you can deduct those. Also, you can deduct up to $10,000 of state and local taxes. This figure includes state income taxes paid, local property taxes paid if you're a homeowner, or taxes paid on personal property. Collectively, across all these things, you can only deduct up to $10,000. If you own a home and have a mortgage, you can typically deduct the interest paid on that mortgage. You can also deduct any interest you pay on your investments. Like if you borrow money against your brokerage account and pay interest on that borrowing, that is eligible to be deducted. Charitable donations are also deductible, as are any unreimbursed casualty or theft losses you experience related to a federally declared disaster. Like if your home was destroyed in a hurricane that was declared a federal disaster and your insurance didn't cover the entirety of your loss, you can deduct the amount of loss not covered by insurance. So after adding up all of your itemized deductions, compare that total to your standard deduction. Whichever one is larger, that's the one you're going to want to deduct. Subtract that deduction from your AGI, and that's your taxable income. Once you know your taxable income, next you figure out the tentative tax amount owed. And you do that by running your taxable income through your respective marginal tax brackets. The tax brackets are called marginal because not every dollar of taxable income is taxed the same. Instead, some of your income is taxed at one rate, some more is taxed at another rate, more is taxed at yet another rate, and so forth. Marginal means the rate that applies to a given bracket or portion of your income. Let's take a look at the tax brackets for 2020. The marginal tax percentages range from 10 to 37%, and the brackets for which the income thresholds start and stop for each tax rate depend on your tax return filing status. For example, if you're single, your first $9,875 of taxable income will be taxed at 10%. Then any taxable income you have above that and up to $40,125 will be taxed at 12%. And then above that, but up to $85,525 will be taxed at 22%. Keep going all the way up until your taxable income is $518,401 or more, at which point that will all be taxed at 37%. As you can see from this marginal system of taxing blocks of income at different rates, you're going to end up with some final blended tax rate, which is called an effective tax rate. As an example, assume you're single and you will have $90,000 of taxable income in 2020. The total amount of tax on that will be $15,680, which will equate to a blended effective tax rate of 17.4%. This is important to understand because even though $90,000 of taxable income will be in the 24% tax bracket, it doesn't mean you will be paying 24% on all your income, because the majority of that $90,000 will be taxed at the lower rates of 10, 12, and 22%. All said and done, even though your marginal tax rate will be 24%, your effective rate will only be 17.4%. We're not quite done yet. Up through now, we've only calculated your tentative tax amount. It's possible you may have some tax credits. Credits reduce your tax bill dollar for dollar, and there are two types of tax credits: refundable and non-refundable. Refundable tax credits not only reduce the amount of tax you'd otherwise owe, but they can actually reduce your tax owed to a negative number, which essentially means the IRS will pay you. For example, assume you have a $2,000 tentative tax amount owed, but then you have $2,500 of refundable tax credits. Not only will you not owe any taxes, but the government will actually pay you $500. There are three tax credits that are refundable. First is the Earned Income Credit, which is for low-income working persons. The working qualifier is important. Without having earned income, you can't qualify for this credit. Next is a Child Tax Credit, which is a credit you may be eligible for if you have dependent children under the age of 17. Finally, the last refundable tax credit is the American Opportunity Credit, which you may be eligible for if you have qualifying higher education expenses. Then there are non-refundable credits. Like refundable credits, non-refundable credits also reduce your tentative tax bill dollar for dollar. But unlike refundable credits, non-refundable credits cannot reduce your tax bill below zero. Let's use our same example as before. Assume you have a $2,000 tentative tax amount owed, but then you have a $2,500 non-refundable tax credit. That credit will reduce your tax bill to zero, but not below, meaning you won't get any benefit from that extra $500 of credit. This list isn't exhaustive, but here are some of the more common non-refundable tax credits. You can get a credit if you paid certain taxes to foreign jurisdictions. You You can also get a credit for eligible child and dependent care expenses. Also, there are some educational expenses that can lead to a tax credit. Certain retirement savings contributions are eligible for tax credits, as are some types of residential energy efficiency improvements. And finally, adoption expenses may qualify for a tax credit. After you subtract all of your tax credits from your tentative tax amount, you arrive at your final tax amount. That's how much tax you're liable for paying for that year. Now separately, assuming you had taxes withheld from your paycheck or other sources of income during the year, or if you made estimated tax payments throughout the year, you may have already paid more than your final tax liability. In that case, you'll be entitled to a refund for the difference. Otherwise, if your withholdings and estimated tax payments were not enough to cover your eventual tax liability, you'll have to pay the difference at tax time. Well, that's it for this super high-level summary of the U.S. federal income tax calculation process. I hope you found it helpful. Keep in mind the U.S. tax code is incredibly large and overly complex, and this video only begins to scratch the surface of understanding it. So be sure to always consult a qualified tax professional if you have any questions about your personal taxes. If you haven't already, subscribe to this channel so you can be the first to know when new videos are posted. And don't forget to subscribe to my monthly newsletter, Retirement Planning Insights, which provides informative retirement planning tips and info. Also, be sure to join my free Facebook group, Taxes and Retirement, where you can get answers to all your retirement-related tax questions. Thanks for watching. I'll see you soon.